I know. Well, I know. For example, you every time you make a trade, you you don't aim, like you aim at 300 plus percent. How do you position yourself to make those type of trades? How can regular people go on with their lives and still be able to day trade? Do you have like a maximum amount that you will put into an option or into a contract every time? What is consider a swing trade? Do you think trading in earnings is gambling, or when we say it's not gambling? In the last 6 months, we have had a lot of movement. We're pretty much still flat or up very little since the year started. How do you think the next 6 months will go? How do you go when, like how I was asking you last week, like sometimes whenever you're already up, like let's say 100, 200% on a play, and you get greedy and you start wanting more, not necessarily like for example, you start hitting singles and doubles all the time, and then all of a sudden you hit a home run, and then you start expecting home runs all the time. How do you go about it when it comes to not being so greedy? Let's just say, for example, you start your account with $5,000, right? Regular beginner account, $5,000. You grow it to 10,000. At 10,000, will you take out your money just to ensure that everything after that is profit? I know you're always talking about real estate. What do you what are and I remember you talking about it like a long time ago, but what is one reason that you prefer real estate compared to regular day trading options or just regular day trading contracts or trading contracts overall? I know you don't like pretty much day trading, but for a beginner trader, what are some ways that, well, okay, if one decides to day trade, what are some ways to prevent the day trading rule of making three day trades for 5 days? What are some ways that one can get away with it? Do you guys like to trade long-term options more as than actually exercising the option or just playing the contract?
I just play the contract,
Yeah.
but I mean that's just like a personal thing.
No,
You do whatever.
you shouldn't. Only time you should ever execute or exercise a contract, I guess, is if it's like I exercised some of my Amazons back in the day just because I got ridiculous calls and it was just, it's a good ass company. You know what I'm saying?
Right, you can hold that for a
Yeah, if it's
lifetime.
something you're going to be able to hold, yeah, exercise it. But for the most part, it's just like that thing this is why I love real estate. It's the same, and someone even brought that up in the real estate webinar, one of the TTF brothers, because they're like, everything you've taught us with stocks is applicable to real estate. And I said, of course, it's business. It's just understanding finance in in your self interest. We've talked about that, right? So
Mhm.
you have to be able to look at an option play and say, does it make sense for me to hold it, sell it? What is the most optimal outcome based on the risk? It's just like puts. So let's say you buy, you put a put on a $10 company, right? And you get $7 puts, crazy out of the money, and you hit it, right? You make a killing on it. So now you only get one of those puts, right? It goes from, you got a $10 put, let's say, it goes to $7. You're $3 in the money, you've made 300 bucks, right? Contract expires in a year. After intrinsic value, you're probably up like 350, 380. You with me?
Mhm.
Yes.
So now you go and put that into perspective. The stock's at $7 now. How much more are you realistically going to make? Should you keep holding that options contract?
I wouldn't.
I wouldn't either because there's no like at that point. I mean, it's not like if it's gonna. It'll be hard for it to go to zero, you know. And what if it does come up? Then you're already losing money.
Yeah. And fuck if it goes to zero. Fuck if how hard it is to go to zero. Even if it did go to zero. One of the most difficult scenarios, right? you would only make $700, and you've already made 50% of that on the first move. So
I
what you
get you.
you take your profit. Yeah, just like what I was saying with that house I showed earlier. Why would you go and my friend has a $500,000 house. If he paid 400,000 for it, it's worth 800,000 to 900,000. He's saying, well, yeah, I want to knock it down, put 500 grand more into it, and sell it for 1.2, 1. I said, why would you ever put 400 grand into it when you could take $400,000 profit right now? How
Yeah,
much
what?
more if you put in 350 grand to make an additional 150, 200, it's just not worth it. Even if you made another 400 grand, but you're going to have to put in 400 grand more, put in a year of time, wait, and all of that just says fucking risk, risk, risk. What if the market shifts, right? It's not worth it. So same thing with options. You have to be able to decide. The long-term options are going to be good to protect you on the downside. If you buy something and you don't want to, you put in a lot of money and you don't want to lose your premium, or you know what I'm saying, or as much, you still can lose the premium, but it's different, because again, the ones with less time are just going to evaporate quicker and there's no time to recover, anything like that. So, but if you're up on an option or you're saying, I'm playing a long-term option and I'm winning, you need to start factoring after you make a gain in a move, depending on how much you made. Does it make financial sense to hold that asset or should you sell it?
Okay, well, what I did, I think like in February, when Facebook hit like when it fell, when it hit like 160, I bought a long-term option for January 18. I mean for January of 19, and I just see it like honestly, I feel in my opinion, I feel like Facebook could reach 225 by January, um, or at least easily 215, no doubt about it. So if I were to exercise the option then, I'm was $65 on the upside.
So tell me
I
this,
think
you bought it when Facebook is at 160, right?
yes.
What is the strike price on the option? What?
Just give me 1 second.
Okay. Even then, I guess we'll do this. I wanna make a video for YouTube right now. So, hello YouTube. How are you guys? I'm already recording this.
You're okay.
So we'll do this. If any of you guys have questions on anything, stock related questions. I know Daniel, we were gonna make a video. I know you had a lot of questions for me. So hit me with them. We'll start with this scenario and I'll play it back from what I was just talking about. But if anybody else has other questions too after I answer this, we'll get into it.
Okay. Can I start now?
Yeah, please.
Okay. So I bought in May 9. On May 9, I bought 160. I bought 160 call for Facebook for 118.19.
Wait, on May 9th?
Yeah, May 9.
How did you buy a 160 call for $118?
No. On May 9, I bought 160 call for January 18. My bad.
Yeah, but so then you bought something. Oh, May 9th, like I'm confused. This year or last year? Because at May
No,
9th, because May 9th,
yes, on May 9 of this year.
are you sure it was May 9th? Because the stock was at 170. So,
Yeah,
and you
and
bought
I bought 160.
oh, you bought
160
160
call.
shares?
No, I bought a 160 call for January.
For how much? How much?
31, 35.
Oh, so you spent $3,000 on it.
Yes.
Okay, yeah. So you bought it and so you bought it and it was already in the money.
Practically, yes.
Well, no, it was in the money by like $16. So you pretty much spent $15 in premium for that option, right?
Yes.
Okay. So now the contract's probably worth $6,000 at this point, right? Or $4,000,
Uh,
more,
it's 48,000. I mean
48,000.
4,800.
Yeah,
4,800
wow.
number.
Yeah,
Yeah.
because it's in the money by what? 40 $42, and it has $6 now of intrinsic value for January to the end of this year. So, what is your
Yes.
question on it now? Should you hold it? Should you
Well,
exercise it?
yeah, I mean the break-even price, it's 191.35, and I mean even right now I'm still $10 over the break-even price, and I see it as like if I were to exercise this option in January, it will be $16,000, right? But I feel like by then I'm still gonna be, if Facebook does what I think it will do, that it will hit 215, 225 by January, then I'm still up, what is it, $65 per share. So I feel like that's really good.
It is. And you know what I would look for, like in the term of this to be like a good home run, is I would see how time goes and if Facebook holds here, because now you get to cover both options, but then really I would see after this next earnings, and then if it drops, be prepared to take some, or maybe even roll it over, honestly. But it might even make sense. You have a lot of money now. The thing I don't like about it is that there's a lot of, you know, you're just pretty much running on intrinsic value right now. You see what I'm saying? So it's already as if you owed the shares, but now if the stock drops, that's where you could run into issues in terms of if you could start giving back that money. But now what I mean by that is in relation to time. So come close to January, if this thing drops, you're going to be screwed. So you have to think always what could you lose and what is the likelihood of you losing in this case. So I guess the likelihood of you going down to 190 or 160, and but how much did you spend on the contract?
30,000.
So, well, 3,000. So you can, I guess, what, 150? Yeah, so your break 163 essentially.
Yes.
So if you go down to 160, it's like, what is the likelihood now of Facebook coming to 163 by January? That is what I would be cautious on. But now, if the stock continues to go up, I would hold it into the end of the year, kind of like because right now, just like holding the shares, you're holding Facebook shares. It's pretty much equivalent up until time factor gets factored in, essentially. And the only way, being this far in the money, only way your time is going to affect you is if it starts coming down. That's it. Because then you're going to start losing dollar per dollar, because that's one of the worst things. If you go from in the money to out of the money before expiration, it vanishes. So two options could be hold it and wait till the end of the year, wait till even after this earnings to reevaluate it and keep that option contract. And then honestly, and if Facebook's at 225, 250, even higher by January, I would consider exercising that stock and holding it, and just you get to hold the stock with a cost basis of 163 and the stock's at 250. The stock's almost doubled. You see what I'm saying? That would be a situation where I would want to exercise and just hold the shares, because then it's like buying the stock half off, right? That's
Yes, I mean that's exactly how I see it.
Yeah, and that's not a bad option, but you still can't ignore the risk here today, because that is not going to be set in stone, right? It could still come back down, you know? It could come, and if it does come back down, you have a big risk on the table. You have $3,000. That's why the next option could be sell it now. You've already doubled a big amount, you know what I'm saying? You've already made what, 6 grand on this, and you started with 3 grand. You know what I'm saying? 6 grand profit. So that's a pretty good amount. You could sell that and then go roll into a lesser option at that same time frame. But then it will eliminate your opportunity. You're going to probably have to go at a higher strike, which means no exercising, and then essentially you're not going to like getting a 250 contract. But then if it goes to 250, it's not like you get to exercise it. You're just going to be sitting in the same position with a more expensive contract. So it's tough. Right now, you need a balance, which is more important. The long-term aspect, and do you have can you justify your belief in Facebook going there and staying there versus now the safety, take the money while you have it, that's it. And roll it over and still keep in the play and just roll over some of the profits so that way you walk away with money and you're still in the game. And if it still does what you're expecting today, you'll still get the profit off of it.
I get you. I just feel like, well, at the beginning, well, when I did that on May 9th, I believe I had like 24 shares of Facebook,
Mhm.
but I just felt like I have 24 shares. No, yeah, I think it was like 20 shares, something, or 16, or 16 or 20, something like that. And I sold the shares because I was thinking I can just buy a long-term option that's gonna guarantee me 100 shares if I do exercise it. And I mean, I just feel like Facebook has a lot of upside to it.
Yeah,
Like I believe in
I
I
agree
believe
with
in Facebook holding it long term.
I 100% agree with you, but now I'm just understanding the nature of the option that it's risky. Right now, it is equivalent to holding the shares. It's just like you're holding 100 shares, right? But that's because you bought it in the money and it literally just skyrocketed from when you bought it. Awesome. You won on that. But if it does go down, you might still like what happens come January 18, the stock is now at 170 and so it comes back, down to here, maybe even 180, right? And now you only have $17 in the money because you're at 163, right? So you only have $1,700 of profit, but now you're holding those 100 shares. And if it drops below 160 now, you will lose $100 per dollar it drops.
Okay, that makes sense. I get what you're saying now.
Because and then because right now you have the equity in terms of the intrinsic value and the premium with the time. Now I'm not saying sell out of it now, but I want you to make this decision, but you have to start thinking of what, the profit margin essentially. You have a great margin now. You've made more. Can you make a lot more in the future? Yes. And now it's the decision, are you going to wait to sell the option there, but then are you going to exercise, or do you go now, you already made money, take the play, secure the bag when it's in your hand, and then go and make another option play with some of the free shares or the free profit?
How do you go when, like how I was asking you last week, like sometimes whenever you're already up, like let's say 100, 200% on a play, and you get greedy and you start wanting more, not necessarily, like for example, you start hitting singles and doubles all the time, and then all of a sudden you hit a home run, and then you start expecting home runs all the time. How do you go about it when it comes to not being so greedy?
Go back to what works. If you're saying you're hitting singles and doubles all the time, there's a baseball player, San Diego, California, Tony Gwynn. You ever heard of him?
I have no idea. I don't have any idea who he is.
You don't know who Tony fucking Gwynn is? What the fuck? You're from
I
Texas.
don't, I, I don't even watch baseball.
It's I don't like baseball that much either, but he was my favorite player at one point when I was a kid. But even then, he never hit home runs. He had the most base hits in MLB history, and he went to the Hall of Fame for that. If you're hitting just take them, and if you let's say you're going for singles and doubles, you hit a home run, fuck yeah, take the home run. No one's gonna say, don't give the points back. but then don't start swinging for the fences every next at bat. You see what I'm saying? Because
Yes.
you will build a career out of singles and doubles. You know, that guy stayed in the game longer than Mark McGwire and Sammy Sosa and any of those other motherfuckers. You see what I'm saying? The home
Mhm.
runs are great, but that's not always going to get you the win. You know, and if you want to compare home runs and even the concept of baseball, you have a whole fucking team. So if you don't hit a home run and you go 0 for 3 at a game, you still have a whole other team that could put up points on the board. See what I'm saying? If it's just
Ye-
you, keep hitting the singles and doubles, and then, but always, it doesn't mean don't put yourself in a position to hit home runs, but don't try to hit home runs every time. Does that make sense?
Yes, that makes a lot of sense actually.
Yeah, so that's the approach I would take for, and like I said, just call timeout, go back to basics, and go for the singles and doubles. And it doesn't mean you won't hit a home run, but as opposed to if you're always hitting the home run, usually players when they try to hit home runs, it doesn't lead to base hits all the time. It usually leads to pop flies, striking out, or foul balls, and then they foul, strike, or really just they foul out, or they pop fly, and that's it. Easy play.
I know. Well, I know. For example, you every time you make a trade, you you don't aim, like you aim at 300+%. How do you position yourself to make those type of trades?
I don't put a lot of money. I'm only going for 300% because I'm putting $40 down. You see what I'm saying? You're putting $3,000 down. You're putting $300 down. That's a whole different ball game. You see, I'm trying to make 300% on $40. That's like what, $120, $180, $200, and then sometimes I make 400. Awesome, right? But
Hmm.
I'm not putting $400 trying to make 4,000. It's the same, in finance. Like that's why like hedge funds and people, a lot of, and this is what happens to a lot of new traders. They start trading, right? They take $10,000, they turn it to $25,000. They think that they're fucking, the next top trader in the world, right? They think that, well, yeah, serious. They think, oh man, I'm gonna run a hedge fund one day. I'm gonna do this. I'm gonna do that. That's not the case because it's a lot easier to grow smaller amounts of money into larger percentages. You with me? Versus take the guys like Warren Buffett, David Tepper, Bill Ackman. They make 5% on their money and 10% on their money. The world hails them as some of the greatest investors. And it's funny because a lot of uneducated or newer investors will say, oh, well, it's only 5-10%. I'm going to make this much trading crypto or trading options. They're missing the fact that these guys are growing 10% of $1 billion. How much is that? See what I'm saying?
I mean, I feel like at the end of the day, 10% is 10%, regardless of how much you put in.
No, not at all.
You don't think
Yeah,
so?
no. So would you rather have 100% of $40 or 100% of $400?
$400.
So then that doesn't make sense. I thought 100% is 100%. Okay. How about 10% of $40, 10% of $400?
10% of
Oh,
400.
yeah, 10% of 100.
Well, you're just ass backwards then. You just lied to me. I thought 10% is 10%. Yeah, I'm gonna give you $4 next time I see you. If you give me 4. I'm like, thank you for your investment.
But
$4.
the way I see it is like, let's just say you put in $100 into a play, right? And then it gives you 20%. I mean, you're still making 20% of your money regardless.
Agreed.
Of it,
That
obviously
that
the
I we're on the same page there. But now it's the focus of what you're trying to do with your money. You see? Because now I'm not going to take $100, or I could take $100. I'll be acceptable making 200% on it, right? But if I take $100,000, fuck, I'll take 5% on that. You see what I'm saying?
Do you have like a maximum amount that you will put into an option or into a contract every time?
No, I don't have a maximum because every option chain is going to bring it brings different, it's a different story. It's a different context every time. Some options you can't get them that cheap, right? And some options are really cheap, and it all depends on the movement of the stock. But I do have kind of like a unwritten rule of just risk. What I would say is I'm not going to try to put in a large percentage of my account, or I'm going to relate it to how much money I made that week or that month and not try to throw in too much money and give back a certain percentage or risk a certain percentage of my gains.
Okay, I get you. Because for example, something that I do, I try not to go over $250, $300. And that's just because like by that time I get say two to three contracts, right? And then I run into this place where it's say you get some contracts for $10, $15, $20. So I feel like whenever I do buy a contract that's $20, I'm like, hey, you know what? I'm just gonna put it at 6 contracts so it can be 120, for example,
Mm-hmm.
because I feel like the percentage is gonna be. I mean, it's 10% per contract, so it's obviously gonna be more 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 money. And sometimes is that you?
No, the card.
Oh, I thought it was a TV on. Um, and so honestly, sometimes I feel like I make 40% of my money, and then I'm happy with it. And then I'm like, all right, I made 40% out of it. Well, okay, I'm going off of track. But what I mean is that if I'm trying not to go over $200 every time, and I occasionally come across this good place that are $30, $40, do you recommend that I still put in the full $200 that I put per play, or should I go a little bit lower? Or do you understand my question?
A little bit, and I think I'm gonna go back to if you're putting in, 200, $300, I'm gonna advise you start being happy with $50, $100, or 150%, 100%. You see what I'm saying? Because
Yes.
it's on a big amount. Because if you put it into perspective, you put $250, make 100%, right? You made
Mm-hmm.
$250 profit. That is the same thing as me buying a $25 contract and going 1,000% on it. You see what I'm saying?
But you're risking less.
Yes, but now is it easier to go up on an option 100%, or is it easier to go up 1,000%?
100%.
You could do 100% all day if you're willing to risk that much money. In general, I just don't like throwing $250 on every option left and right, regardless. And that's so if you're saying, should I put more or less money? I'm always going to advise you put less money and take advantage of how options are structured. You know, when they do good, they do good. You might as well put little bit amounts of money to make a lot versus starting to increase your payout trying to get more. But also that's one level of it, but then you also have to kind of have the mentality of being comfortable with how much you're making. And again, just look at the net profit. What are you walking home with at the end of the day? And what is the
I get
safety and risk of it?
you. I get you. So, I was gonna ask you something else. Give me one. I totally forgot. My bad.
No worries.
I have well, yesterday when we were talking about it, I actually wrote down some questions. Um, to a beginner, I know you don't like pretty much day trading. But for a beginner trader, what are some ways that, well, okay, if one decides to day trade, what are some ways to prevent the day trading rule of making three day trades for 5 days? What are some ways that one can get away with it?
By using a cash account. So You'll have to do a cash account, no margin, but even then, you can only trade as much cash as you have, and it'll take after you sell, you won't be able the profits, you won't be able to reinvest them for 3 days until it settles. So that's one way, but the number one way I use myself that's just easy and it applies to this question, and you're gonna hate me when I say this, don't day trade. But simply, if shoot for 24-hour plays. So yeah, let's say you get into a play, you put in $50, $100, and it goes up a ton, and you need to sell out. Yeah, fucking day trade, sell out that same day, get the profit. But on the reverse end, if you could go buy a play, you'll see most of my plays are like that. I'd say 90% of my plays where I make a killing, I buy them the day before, 2 days before. You see what I'm saying?
Yes.
And I just sell it the next trading day. That is a day trade, but it's not technically a day trade. You see what I'm saying? It's not like I'm holding it long term, and that way you could trade as much as you want. You could use margin, and you're not going to have to deal with a lot of that shit. But that's what I would recommend, or simply the only way to go around it if you're trying to circumvent it is by using a cash account. Cash accounts are not obligated to those same rules.
Just give me 1 second. I'm getting the next question.
No, that's for like 5 minutes.
Well, okay. One more thing. I was gonna say, I know you're always talking about real estate. And I remember you talking about it like a long time ago, but what is one reason that you prefer real estate compared to regular day trading options or just regular day trading contracts or trading contracts overall?
The safety of it, and it goes back to that first question I answered with you about, when I said you put $100,000, you want 5% of 100,000 or 5% of $100? You would take the 100,000. Any self-interested person would. That's what I like about real estate. It's bigger amounts, but you could still leverage your money just like the stock market, where I could go get a $400,000 house for $10,000, but now if that house goes up 10%, I just made 40 grand as opposed to making $40. And then also it's real property. It's a real asset. So that way I can't get, there's no way I'm going to lose the security of that. It takes a lot more. But now, as devil's advocate to that, on the other side, the downside of real assets, and real assets are shit that you could touch, you could feel, they're bigger and harder to move. A car is even though it's depreciating, it's a real asset. Think about how long it takes to sell a car. Think about how long it takes to sell a house. On the other end, why I like the options and trading and contracts, you could leverage money a lot more. It's a lot faster and it's a lot more liquid, and it's easy to move money around and get in and out of a situation, which could be advantageous at times. But at the end of the day, I prefer the larger gains that real estate provides as well as the safety that it provides. And literally it's not as complex, even though you guys see the work I put into the markets and how much I understand financial markets. It's easy to understand real estate, and it's already simple to begin with. So if you add that level of complexity to real estate, you're able to profit tremendously, even more than the average person.
I can agree with you, but the way I see it is like, let's just say you're gonna go buy a house, right?
Mm-hmm.
And just a regular house, like just say you're buying a house and you buy it for 100K, right? And a couple of months later, the market crashes, and now your house is worth 50 grand. So you just lost 50 grand as compared to stocks. I mean, I think it'll be pretty hard for someone to even put in 100K into one stock and for it to drop 50% like that.
Well, that's the thing. What I would tell you is now Go find me a time in history in the last 10 years, right? Or you could even include the '08 crash if you want, and you're only going to come up with probably one, but when was the last time house prices dropped 50%
I think it's just been once, right?
It's been one time in almost 100 years that's ever happened. Now, go look at the stock market. We were just talking about it earlier. 3 weeks ago, they removed General Electric. Those are the guys who make most appliances in a lot of houses. They removed them from the Dow Jones. General Electric has dropped 50% just in 2018. It dropped another 50% the year before that. Now go in the last 10 years and find me how many stocks have dropped 50%. You can't even count. A lot of them have dropped 50%. Ask Bill Ackman. Ask fucking anybody. Ask even Elon Musk at times. His stock has gone down 50%, but it's also gone up. And now, at the same respect, when you're looking at, you know, how often it goes down, how often it doesn't, stocks, it's a lot easier to lose 50%. I'll even tell you a story. I have this one friend of mine. I brought him on webinar before. I don't know if you remember him. You remember Don? Were you ever there?
No, I don't think so. I don't
Well,
remember him.
he had this debate with me, and he actually, he was a big, he only owns one property. He owns one property, a beachfront property in San Diego. It's like $4 million, dope pad, right? That's the only property he owns. He has $15 million all invested in the stock market. That's all he does. And I told him, I said, you need to go get real estate. And he said, no, why would I do that when I could just, same thing you said, I'd rather buy stocks. I don't want to deal with the property. It's risky. And I could get dividends. I could collect rent on stocks. I said, sure. And what he did, he bought a real estate investment trust. And he also bought coal. He put $2 million, $1 million into a real estate stock, and $1 million into a coal company. And both of those, this was from 2015 to 2017. In that 2 years, by the end of it, he lost $500,000 on each of those investments. They went down in value. Whereas if he bought property in 2015, he would have probably been up 30% on $2 million. Whereas now his $2 million turned into $1 million. So stocks are easier to go down and lose. It's no question about it. That's why people are even hesitant of the stock market on an average consumer level. It is risk. It's volatile. It moves a lot more. But what you get, why do people like it? Because you can make money faster and you could exit faster, and it has less maintenance. You don't have to deal with a stock like you do a property. See what I'm saying?
Yeah, so how long, on average, how long does it usually take you to sell a property?
It depends in that it's just like even a stock, right? Let's say, obviously stocks are faster, no question about it. Average 30 days, but you can do it faster. It all depends now, just like any asset, the price you put it at, right? It's like if I wanted to sell my Facebook shares right now at $210, how long would it take me to sell those shares? A decent amount of time. But if I wanted to sell my shares at $200 right now, I'd sell them in a second. Same thing could apply to real estate. If I had a $200,000 property, if I wanted $225 for it, it would take me some time, at least 30 to 60 days. But if I said, hey, I'll sell it for $190 right now, $180, I would sell it probably in a week. But it would probably take minimum a week just to go through the process of closing, contracts, escrow, etc.
Okay. I have another question.
Mm-hmm.
In the last 6 months, we have had a lot of movement. We're pretty much still flat or up very little since the year started. how do you think the next 6 months will go?
If I had a
And relates to
crystal
the
ball,
Dow.
man, I would be betting on sports a lot more. Tell you that much. But it's hard to say. I don't know where it will be in the next 6 months, but in the next 6 years, it'll be higher. I could tell you that. It's hard to say. What I am looking at, you already know I've taught it. I'm looking at the yield curve. I'm looking at economic data. I'm looking at these emerging markets. And I'm also looking at just the individual performance of some of the big companies that make it up. But it's hard to say. But realistically, in the next 6 months, we have some turbulence, but not enough to say that it's going to bring the market down. And it'll either be at the same price or probably a little higher unless one of those factors I just mentioned earlier hits the market and makes it come down. And I'll even say, as a trader, if you're trading options and you're quote unquote trading, what happens in the next 6 months shouldn't matter to you, as crazy as that sounds. What should be more important is the velocity to which a move happens. This isn't important to you as an options trader because time premium, you see this moment from May 2nd to here. This is bullshit compared to what you want this, and you want this, and you want this. You see what I'm saying? Or you want just straight up throw a long-term option and cash out on that. Does that make sense?
Because of the volatility or because of
Well,
what?
it's volatility, but it's also time premium and just direction, and just you either want a big move on the underlying asset or big moves that are happening in short time periods to maximize your earnings potential.
Do you think you could, I mean, I don't know if I'm allowed to or not, but do you think you could take me to your last trade when you make like 300+%?
I just posted it on YouTube.
Oh, that's because as soon as you posted like I got the notification for YouTube, and then that's when you posted the webinar code, so I just came to the webinar.
Yeah, watch that. I showed two plays. I did two different plays where I
Okay.
made almost I made 1,000% on one and then just under that on the other.
Okay, I have a question. Where?
Swing trade is anything. It's usually about a couple days to a couple months. So it's less than 12 months and it's longer than 10 minutes or 24 hours. Or it's about like 24 hours could be a swing trade. But even then, that's a very quick swing trade.
Okay, so for example, in one of your videos where you turned 3,000 into 30,000 on, I believe it was Amazon, right?
Amazon and Netflix. I traded
Yeah.
Netflix. I put $600 into or I put $300. I think it was 600. I think it was 600 to 30,000 into Netflix and earnings, and I did it about a week, 2 weeks before earnings, and that turned into 9,000. Oh no, I put 300, and then that turned into 9,000, and then I took $6,000 of that 9,000. I kept $3,000 of it to make sure I still walked away with money, and then I put that $6,000 into Amazon contracts the next week for their earnings, and so that took me about 2 weeks.
So, okay, I have another question. So let's just say, for example, you start your account with $5,000, right? Regular beginner account, $5,000. You grow it to 10,000. At 10,000, will you take out your money just to ensure that everything after that is profit, or will you keep the whole $10,000 in there?
It depends on the track record of what you're doing, but I would take out some money and just put it in the bank and walk away with something. Best case scenario, $5,000 and start back over with $5,000. But that is a question that varies from person to person. So in the financial advising industry, what I would teach and what I've taught a lot of people is people ask me how I do it. I teach conservative. You see what I'm saying? I'm a conservative investor. Even though I do shit like options and weeklies, I'm still very conservative, hence the amounts I play. But answering that question, there's no one size fits all. That depends on your risk appetite, your financial situation, and what that money means to you and what you want to do. You see what I'm saying? That's simply what is your appetite. If you want to be conservative and you want slow money, consistent over time, always going up, like let's say you went 5 grand to 10 grand in 3 months. If you're cool with doing that once every 3 months with a high probability of success, do that. But if you're going, no, I want 5,000 to 10,000 and then 10,000 to 20,000 in 3 months, and I'm cool with losing all my money and starting over, do that. It all depends on your risk appetite, and that's how it is. Because that's how it is with real estate, And people who come to me for investment and managing money, they'll say, hey, what should I do in this case? Should I go and, I want to buy a house. I want to make a lot of money. I want to make a lot of money quick. Remy has somebody who gave me to invest, and that's what they're coming to me with. They said, I want money quick. I want money fast. And I like real estate. I said, okay, we're going to flip a house. Easy. It has risk. It has time, but that's going to be the quickest way. If you're saying, I just want guaranteed money over time, but I want more than the average 1%, I'm going to say buy a property and hold it, rent it out. I want a middle security. I still want a higher upside, and I want the safety, but I want more than just holding a property. I'd say buy the property. You don't have to completely flip it, maybe fix a little bit and flip it, or buy a property, hold it, and Airbnb it. So then you could get more short-term rental. You still take on some more risk, and that's it. But it's all about your risk appetite and how you're determined, how you're set up to deal with that.
Do you think trading in earnings is gambling, or when we say it's not gambling?
It's always gambling to a degree because earnings you truly never know. And it's not gambling when the odds are in your favor. And that's when companies haven't moved in a long time, but they still have the potential, or it's a company that is truly doing great fundamentally and they've had increases in their bottom line, just revenue, profits, everything. And the company is significantly more valued than it was before or has that potential to be. So it's when the odds are in your favor. And then the last part is when you could tell that by the premiums not being high and a lot of people not looking at it, investing in it, and expecting a lot. So earnings aren't really as much as a gamble when the expectations aren't too high. That's when it becomes easy. That's when it becomes, or not easy, but the odds become more in your favor.
Okay, I mean, now that you're saying that, I remember Nike when they reported, was it last week or the week before? I remember them, like, I was looking at the options chains the day after, or the day when they reported earnings, and there were some that were like up like 2, 3,000, 4,000%, just because no one really betted that they were gonna keep going up, And I think that when they reported earnings, they went up like 10%. So I guess I understand what you're saying to that degree, but when would it actually become like you gambling? Like, because I know a lot of people make money off of earnings, but a lot of people just gamble, be like, oh, I think this is gonna go up or whatever,
So you're saying when does it not become gambling? Like I said, in the situation of just not.
No, I said when does it actually become gambling?
Oh, when everybody's looking at it, when there's been the history where the stock's already increased a lot over time, and it's not like it's already expected that they're going to do good and how much. So like Amazon, back when I made money on it, a lot of money, it wasn't as much as a gamble because people weren't expecting them to do good. But when you look at their underlying growth, if you put it on a chart, their profits, business, everything, the revenue was going up. They just kept spending more money. So then when they started spending less and turning even more profit, then people started to recognize it. After 3 earnings later, now everybody's perception shifted to not is Amazon going to do good or bad, but how good are they going to do? That's when it becomes a gamble, because now you're just trying to pin the tail on the donkey at a certain price versus betting oh, I think it's, they've performed versus they didn't perform. You see what I'm saying? It adds a second level of performance. That's when it becomes more gambling because it's harder to put it on there. So if it's saying, if it's as simple as looking at the company and analyzing, and you could tell through the premiums, you could tell through public perception, the fundamentals, the earnings, yeah, it's simple. Are they going to perform or not? That's less of a gamble than, okay, we know they're going to do good or we know they're going to do bad, but how good or bad? See what I'm saying?
So I know, for example, okay, I can relate. Okay, I understand that because, for example, almost every quarter that well, not all of them, but I know a lot of quarters for when it comes to Tesla reporting is always says like $3 loss and stuff like that. So it's like not how much they're gonna do bad, but how good are they gonna do compared to that?
Exactly, or how less of bad or how more of bad, because it's already there. But now give it a few quarters. Like let's say you're able to see data and you can understand the market in Tesla that wow, they're truly changed. Even though they're not doing the best, they've now started to shift in a positive direction and they're showing a consistent pattern of going up. But the market is still left behind with that thought that, oh, how bad are they going to do? How bad are they going to do? That could be the opportunity versus, okay, we know they're going to do bad, but how bad? Does that make sense? Because it doesn't
Yes.
necessarily mean just if they report negative earnings that it's a question of how bad are they going to do. Because again, Amazon was like that. But when you looked at what Amazon's revenue, profit, and everything, they were doing good. It's just people were still doubting and expecting it. They were expecting them to spend more when they started to show a consistent pattern of spending less and then reporting more.
So, for example, um, the last time Netflix reported, they were like everyone was shocked at how good they did. To me, like let's just say I were to put a play on Netflix reporting, I believe they reported the 16th of next week, sometime next week, if I'm not mistaken. So if I think they're gonna keep going up, but I don't have any data, and am I just gambling then? I just
Yeah,
feel like since last
100%.
quarter,
If you can't give it, and you're gambling, and then even then go look at the Netflix options, I guarantee they're going to have a premium because now every other person thinking like you, and not, even then a lot of people are already just betting on it like that. So the premiums will be high. So that means even then the market is pricing a higher point to the upside. So it's gambling because simply with all those, when you put those factors into place, you have less odds in your favor that it's going to do well.
okay, that makes a lot of sense. That really makes sense. I was gonna say, so in that play, when we are talking about earlier, when you turn the 300 into the 9 grand, and you traded ahead of earnings, were you gambling at that point, or what were you looking at it to that degree?
No, because at that point, people were thinking, people didn't expect Netflix to do well. You see what I'm saying? People just were not expecting it to do what, it was just a matter of did they perform or did they not perform? And they performed and then did amazing. But then again, if you looked at the trajectory of how they were increasing subscribers, how they were growing their plans and them executing on their past plans, it was all lining up. And then the same thing applied for Amazon as well too.
Okay, so when it comes to growing a small account, it's obvious that one's not gonna win 100% of the time, right? I mean,
Yes.
I don't think no one can really win 100% of the time. So what are some things that you can recommend that, like for example, I know that I'm not gonna win 100% of the time, but in order to grow my small account, I need consistent wins. What are some things that you can recommend to where I hit consistently and I don't go out of my way just to make an extra trade?
It's going to be by trading less. So it's harder. The more shots you take, the harder it is for percentages, right? It's easy to go 3 for 4 and make 75% of your trades than to make 300 of 400 plays. You see what I'm saying? You have more opportunity to fail and lose. It's kind of the same reason why Shaquille O'Neal has an awful free throw percentage. Was he bad at free throws? Yes. But there's another part a lot of people miss. Shaquille O'Neal went to the free throw line more than anybody because he was always in the paint. He was always big and going up strong. He got fouled a lot, so he was taking a lot of foul shots. So the more shots he took, the more shots he had to mess up. That makes sense?
So even let's just say he went through a free throw line 3,000 times and he got 2,000 points out of that. People still see it like, oh, he failed because his winning percentage is not that good.
Well, yeah, because even then, 50 out of a free throw shot where you should be making at least 3 out of 4 of them, if not more, that's awful. But he did go to the line a lot. That's why he missed a lot. But now, if you made 2,000 points, that's great. You can't knock how many, he still scored a lot of points in his career. But when it comes to money, that's not the case when, again, unless you're consistently putting the same amount every single play and your points are uniform, like basketball, 1 point for a free throw, 2 points for a field goal, and then a 3-pointer. Yeah, sure. You could look at it that same way, but it's just the concept of just the mathematics and the statistics, where and then how it relates to, especially in something as risky as the market, the more shots you take, the more trades you make, the more opportunities you have to fail. It's easy to do a higher percentage and to be more successful by picking and choosing your plays, as opposed to just trying to take a lot of plays and get a certain amount, because then every time you risk your capital, there's a chance they don't come home.
Okay. So, well, I haven't been trading for long, but all the paper trading that I've been doing, I feel like it's a little bit easier to predict the upside on a call than it is to predict the downside on a put. Like, for example, I don't know if it really relates to the market and how much the market really affects a play like that, but I feel like it's easier to predict, like, all right, in 2 weeks, Facebook is going to go up $5 than it is to predict Facebook is going to go down $5 in 2 weeks.
I think that's just the market and how it is now. We're in a bull market where things are going up, There's more instances where you're seeing it going up, but if you're seeing it as easy, and that's good that if it's paper trading, you're detaching yourself and able to see it clearly. But now too, and I will ask, are you paper trading with a realistic amount?
Yes, I have my every so often I restarted it again, but I pretty much always start my paper trade account with $10,000 because that's realistic. That's how much more or less my account has. So I just feel like if I go off of there and I'm able to grow that account from $10,000, then I'll be able to grow it realistically with $10,000 as well.
Good, yeah. So then if you feel like that's easy, I would say even if there's a difference between feeling and fact, and it becomes fact when you go grow that 10,000 paper trade account, grow it by 50%, 20% even, and keep it there after 30 to 60 days, then confidently I would say, yeah, move on to real money or start trying a little bit of real money. You see what I'm saying? But that's how you're going to know if it's easy or improve the perception. But what you're saying about it's easier to see the stock going up than down, it usually is, especially when, the market's designed to go up. And over the last few years, it's, unless there's something comes out of nowhere dropping the market, it's usually going to go up or at least stay the same, which also, don't forget, could be a killer for options.
Okay. Is there anything I know you don't pretty much look at the market every day, but whenever you do look at the market, I know you were mentioning earlier that you pretty much just like to trade on Mondays and Tuesdays. Is there anything that you do prior to, like in the pre-market? Is there anything that specifically that you look at? Do you look at how the company is doing, how the market's doing? What do you look at pre-market?
Pre-market, I'll look at news if it's big enough, if there's something going off, but really the best way I'm getting ready is by looking at the news from the day before or the week before and getting my ideas from there. Because that's what I say the pre-market stuff, if you're watching it, that, and you're sitting there waiting pre-market, watching, wait till the stock market opens, that's how you could kind of get caught up in trading a lot and being kind of obsessed with it, where that could kind of have a negative effect. And even then, option premiums when you're trading option premiums in the mornings are usually higher because there's more uncertainty and the market just opened. That's why I like 9 a.m., 10 a.m. Pacific time, because the market still usually doesn't make too big of moves, but then all of the premium is just wiped out usually to a degree.
Is there anything that you do prior to earnings?
Yeah, I look at the companies and I see what's reporting. I'll try, depending on I'll try to get a good time frame on them and see what's going on, and then try to wait. And I'd let the market, and like a day like today where the market's kind of down, I would try to find earnings plays, but then it was up yesterday, so I'd wait for entries, and then if I like an earnings play, I'll scale in.
Okay, well, pretty much like in the next couple of weeks, there's like hundreds of companies reporting. How do you pick your companies that you want to look at the most? Like, for example, let's say there's 100 companies reporting next week. How will you narrow it down to which ones you want to look at? And will you be okay with missing other ones?
Yeah, I'm always okay with missing stuff. I don't, I'll get a little frustrated at times, but as long as I don't lose money, or as long, you know what I'm saying, I'm cool with that. But how do I pick the companies? You've seen me do it. It's just from my financial knowledge on these companies, my knowledge literally of what company is what. I go through the options calendar. It should look familiar if I did this. I'll go and, let's say we'll go down to July 18th or July 24th. There's going to be 173 companies, right? I go through these companies. I know which companies I already have information on them. So let me see. I could go pick on this day. Which ones do I know? I know MindBody. I know they've had a history. I know they're a growing company. They're not too big. They're still kind of small. That's one I know they can make big earnings moves. I know Rent-A-Center. I know that business. I could pull out. I have I've looked into all of these companies. Discover's one, but I would want to relate that to the financials, and I kind of stay away from those. PayPal. I know about PayPal. I know their earnings, and I know their perform. I monitor them over every quarter. You know what I'm saying? These are the earnings reports that I keep up with and I look at. AT&T, but I usually don't play them because I know they don't move. But if I could, I might look into them and see kind of how they're performing in option premium. And if, those are ones that they haven't, this is one of those where if I could find evidence to the odds being in my favor, this could be a big mover, because 9 out of 10 times this bitch doesn't move. You see what I'm saying? But
yeah. Do you look at volume and open interest a lot?
No, I have a video on it. I'm gonna post it, but no, I don't give a shit about volume and open interest.
Well, why? Because the way I see it, I feel like it's a good like it shows you a little bit of pretty much supply and demand. Be like, oh, you know what? A lot of people are betting against this right now. A lot of people are going with this right now. What's the reason that you don't really focus on volume that much?
I look at volume for the stock, but when it comes to options, I don't give a shit. I explain it in the video, but there's too many ways options can be used. So if I buy a put and a put is open, right? It doesn't necessarily mean I bought it. I could have sold it, right? If there's open interest in volume on a put, it does not indicate anything about the company at all, because you don't know the reason why people did that. That makes sense? They could have been selling
Yes.
premium. They might own 1 million shares of the stock and are just selling calls to collect rent on it. Doesn't mean that they have an interest in it. They could actually mean the opposite. So options can be used way too many ways versus even the stock. They're either buying it or shorting it. But even then, it's not the same demand as, like, that's why I like real estate. It's way easier to look at sales data to say that's demand. It does. I prefer the stock volume itself versus options volume, but options volume in open interest, I don't look at it for, I don't give a shit about it.
Makes sense. Okay. I think, well, my last question, well, the last question that I wrote down. Hold on. Oh, okay. No, I actually have a couple more questions.
I'm
I
giving,
say, how can a rig?
I'm gonna give you one more, so this isn't too long.
Can I get two more?
All right, I'll give you two more.
All right. How can regular people go on with their lives and still be able to day trade? Because I have had, well, since I'm a barber, right? It's hard to be doing my regular job and still being able to keep up with the market and stuff like that, and like with the trades and stuff.
By any, the concept of an hour a day when you're not working, look into the market, get into a pattern, a schedule of just reading about the market, always be reading about it. And then, like I said, don't put yourself in day trades that are risky, but swing trading, plays that, yeah, you could buy today, sell tomorrow. You could utilize alerts where you could set a point, and if it reaches that during the day, you get something on your phone, and yeah, you could take care of it. But don't try to day trade as much as you're swing trading, even on a quick swing trade for buy today, sell tomorrow. You see what I'm saying? Find something at the end of market, buy it, check it tomorrow morning, sell it, and go from there. Or wait and do that type of thing. That's usually what I recommend.
Okay, I mean, that's good because I feel like that's gonna set me back from actually looking at more good plays instead of looking at all the plays and be wanting to do all of them. It's like, all right, I only have
Exactly.
an hour today. Okay. My last question is, do you like buying houses on auctions.com? Or do you like buying houses on auctions overall?
So we have in the real estate course, you're gonna get access to it. Well, are you gonna take real estate seriously? I'll hook you up with it if you are. If you're gonna be involved with it, I have because this is a 30-minute answer alone. I have a full lesson on it of how to use auction.com, the other sources you could use in this. Do I like it? Yes. Do I like it for beginners? No. If you don't know what you're doing with properties and real estate, auction is not a good look if you don't have any guidance with it or any experience or education on it. You have to educate yourself before looking into it. If you can, it is a good opportunity. And there is some, but it's always going to be few and far between. Even though it's on auction.com, it's like its own market. It's kind of like a lower level of retail, but it's not the same as finding a house and generating the lead organically.
Okay. Do you feel like there's a lot of how can I say? Because for example, I feel like whenever you do buy a house there, it could be good, but there's a lot of like you haven't seen the house from the inside. You don't know if it's missing anything,
That's
stuff
the
like
risk.
that.
And that's the risk a lot of noobs make, because if they don't understand that, they get crushed, because one little thing could change the whole dynamic of a house. I have this house we're buying for like 360. I found out it has mold, and that's going to be a quick fix. But then I was looking at the pictures the other day, and I saw that the mold was kind of by the air vent, and I was like, shit, that means the mold could have carried through the whole air vents, the whole HVAC system. And if that's the case, a $10,000 fix could have been a $50,000, $60,000 fixed, and now it's not worth it. So that's why when you're doing an auction is as is. You're buying it. You know, if you overlook something, that's it. You're screwed. So that's why, and it is easy to mess up. It's like buying a car at an auction. That's what people don't. You know, people will buy cars at auctions. It's the same thing. When you buy an auction, you're buying it as is, no guarantees, no warranties, nothing. And if you overlook something, you're either going to lose your deposit you put down for making that offer and getting accepted, or you're going to buy a worthless piece of junk.
Okay. Well, I mean, I think we're up. So I just want to say thank you because I know you're always busy and shit. So thank you for taking out the time and answering my questions.
No, hell yeah, they were good questions. I think they'll help a lot of people. I think a lot of people had similar questions. So those are really good questions and thought out. I appreciate that on your end. So that's good, man. I like it.
I mean, appreciate you.
We'll end for the. I'm doing this on the YouTube video. We'll end it there. We'll still stay on the webinar, but let me go to the bathroom real quick. Everyone, I love y'all.
All right.
Stay in school.
Stay in school.
Love you too, man.